And Chris, all of this is good news for the portfolios. Now, Jeff mentioned value as a style. Could you just describe a little bit, please, about the different styles that we use within the portfolios and how that's to the benefit of the investors?
Yeah, absolutely. I think, the reality is what Jeff has just mentioned is one word, which is diversification. And that really is key to what we do within the portfolio. So what we definitely don't do is anchor on one single style. And what we have is a group of differing managers, all with differing styles, differing specialisms, all with different ways of working in current market conditions. So if we think about the different styles that we have within the portfolios, arguably we actually have all of the traditional styles that you would find within investment within the portfolios already. So we do have value in there. So if you look over the month, the best performing manager was SEI. So SEI do have a value skew, and that's worked extremely well for them. As well as that, we do have other managers such as, let's say, Close Brothers, who have maybe a little bit more of a growth bias. And actually that's worked well in previous months, where you've seen the leadership from those larger tech companies, particularly in the US, continue and come through. So I think from our perspective, actually within the portfolios, we're incredibly lucky in the sense that you're not just anchoring around one idea, you have all those different styles in there.
And Chris, just basically, what's the difference between value and growth?
Yeah, sorry, that's a good point. So basically, when you look at value, you're looking at stocks that are undervalued. So basically, you're looking at stocks that the stock market is basically pricing at a lower value compared to what is their real worth, in your opinion. So value can quite often be areas that are quite out of fashion, things that people aren't really focusing on right now. And growth is basically your belief that a stock is doing well, it has momentum behind it, and it will continue to do well. So probably the best example of that, things like the big tech companies, which have done exceptionally well. Things like Netflix was the stock of the decade, wasn't it? And there's the belief there that because of their business models, that they will actually continue to do very well.
And how has this translated into portfolio performance over the last month, Chris?
Yeah, I'm really pleased with performance. What you've seen is the balanced portfolio over the month is up around about 4%, just over 4%. All the portfolios have given you strong positive returns. Now, as Jeff said, you've seen really good performance from equity markets. You've seen really good performance as well over the month from the higher risk areas of the bond market. So certainly from my perspective, it's been a great month for returns.
And when we get into the portfolios that have a higher equity content, I guess we're 5-6% growth on the month.
Yeah, roughly, yeah. So when you look at, say, aggressive or growth plus, you've seen very, very strong returns, which is great.
Good. And part of the diversification story, it's not just about equities. Bond markets are often overlooked because it's the equity markets that get the headlines. The news flow is all about equities, but bonds have got a crucial part to play in this. And Paul, from your point of view, there's a couple of things happening in the bond markets which are really interesting at the moment. You've got the European situation and you've got new issuance. Can you tell everybody a little bit more about those 2 points, please?
Yeah, I think bonds have been very interesting over the past couple of months. I suppose if you've got your sovereign bonds, which get a lot of attention, so your UK gilts, your US treasuries, but the more interesting area for us over the past month or two has been the corporate bond market. What you've seen there is a real game changer from the Federal Reserve. Around March time, what you saw is spreads. So this is credit spreads, which is the premium investors require for the credit risk. You saw credit spreads really blow out as equity markets sold off in the wake of the coronavirus. But since then, the Federal Reserve stepped in and expanded their asset purchasing program to incorporate investment grade corporate bonds. And they also included a term called fallen angels, so investment grade credit, which has been downgraded into high yield. So what you've seen since then is spreads come in and investors being rewarded if you've owned those assets. So for growth aligned, we've been increasing our exposure to corporate bonds, and we've done that in twofold. We've done it via a passive strategy, which is just buying US investment grade, and we've done it by a new active manager from Allianz. We believe in this environment, it's good to have some passive, but also good to have some active. Having a blend of both gives you a good risk-adjusted return. But having active management in the bond space, we believe, is very important. Being able to have a manager that's got the skill to identify the good corporate bonds, the good bonds from the bad. So we've introduced a new manager over the past couple of weeks, and just looking at the performance of the two new holdings, they've done very, very well for us over a short period of time. What we really like about the new active manager that we brought in, they've got not only a great long-term track record, but they've managed this very volatile period very, very well, providing good returns, but also providing excellent diversification. So it's been has a very low correlation to equities, which is exactly what we want. So we benefited from strong equity markets, strong bond markets, but also had that diversification, which is effectively giving you a really good risk-adjusted return.